Okay, good to have everyone here. Very wonderful to have a full room. I guess more people are still coming. Okay, but nonetheless, it's wonderful to have you here for strategy class, and we're going to be looking to improve our trading or looking to enhance our trading by some very basics, not basic concepts, but very core concepts. If applied properly, can maximize your efficiency in the markets. Okay, but before that. If you're new to trading, there's one thing you need to understand, whether you're new, you're advanced, or you're a professional trader, there's always something to learn. So today, what we're going to be looking at, or what we're going to be discussing, is actually something quite profound. I'm not going to come today's class, I'm not going to look at a specific trading strategy, but what I'm going to show you is something I do and how this enhances my trading. And that's what I like to call the MTFA, that's multiple time frame analysis, and how that is actually powerful for you to be able to know where you are in the stream of things and how you can take advantage of what opportunity makes the most sense. Now, most of you understand the concept of, let me just write it out here. Most of you understand the concept of multi time frame analysis. Now, what I need you to understand is many times people confuse time frame. So people think time frame is, it's like, oh, you're looking at the market. The market respects time frame. But the truth is the market doesn't care about time frame. The real order flow, the way money is moved in the market is it doesn't have anything to do with time frame. So when you go to the liquidity providers or the big traders, by big traders, I mean big banks like, let's say, JP Morgan, or big financial institutions that participate in the markets like George Soros, they don't look at the market from a standpoint of time frames. They look at the market from a standpoint of orders, right? However, we don't have access to the order books like they do. So we have to look at the markets from a standpoint of fragmented time frames. Right now, the key to trading success doesn't lie in one specific time frame, but it lies in your ability to basically combine your entry time, what time frame you use to basically look for entries, and what type of trader you are. So basically, what I mean from that is, as a trader, you're unique in your own capability. And this is one of the reasons why when it comes to trading, I always tend to teach people that I'm not a very big fan of signal givings and all of those things, even though, yeah, it helps, but it limits you to become dependent. However, if you understand how to trade from a point of view that makes the most sense to you, and also that makes the most sense to your available time limit. So take, for instance, one other person might have the time to just sit down from morning till afternoon to evening, watching the chart and looking for trade. Now, that kind of person can work well as can be a very good, can look for opportunities on the 1 minute time frame, scalping, basically something like that. However, some other person might just have, based on their busy schedule, might only be able to assess the market or really look at the market for trading opportunities once or twice in a day. So you're going to want to set up your system or look for opportunities in the market in such a way that it fits your criteria. So this is where time frame comes into play. Okay, so basically, I'm going to be using myself as a yardstick in most cases, because I'm explaining to you from my perspective of looking at the markets. Now, as a trader, my entry time frame usually is between the 5 minute and the 15-minute time frame, right? So I use the 5 minute and the 15-minute time frame to look for entries into the markets. However, that doesn't mean that I use the 5 minutes and 15-minute time frame to confirm the market direction. Now, what I need you to understand is, once you come to time frame analysis, the markets, the higher time frame has more power or more control over the direction of flow of the market than the lower time frame. Now, what do I mean by that? Now, if, for instance, on a weekly time frame, right? So on a weekly on a weekly chart, you have a situation where the market is moving like this. So this chart I'm drawing on, these lines I'm drawing, let's assume it represents a weekly market, right? Now, let's say this is a weekly time frame, and you can see, so as traders, you're looking at this and you're like, okay, this market is bullish. Why? Because it's making higher highs and higher lows. and you can, okay, this is a bullish market. Now, however, imagine, this market, imagine this area of the market, right? On a 1 hour chart or even a 2 hour chart or a 30-minute chart will look very, very bearish, right? So this market, which is bullish, if you zoom into this area here, now, as you're looking at this from a weekly time frame, you're looking at this market and you're saying this is a bullish market, right? However, if you're looking at this area, so let me just imagine we are zooming into this area, it will look something like this, right? It will look like a very bearish market. Now, imagine you trying to determine or trying to analyze the market and trying to define a trading bias in this market, only looking at this time frame. Well, you'll be seeing a market that is very, very bearish, right? So, which is why it's important to understand where you are in the context of the markets and then figure out how to play that into your own trading system. Okay, so now this idea that that we're floating around here, you'd see how it would help you as a trader, if applied properly, to be able to know when to trade, when not to trade, and when to maybe stay on the sideline. Okay, so now just because there's always market is always moving, this does not mean that you're always looking for trading opportunity, right? Because sometimes the context does not make sense. So, for instance, personally, I like to, I like to trade in the direction of the trend. So, if the market is bullish from my standpoint, I only like to look for buying opportunities. I don't like to counter trend trades. The reason is it's difficult to swim against the current. So imagine if you're in a river and the river is flowing in this direction. So it's flowing like this. And then you want to swim. Your best what I call it, your best bet will be to try and swim in this direction. Now imagine if the current in this market, in this river, is very strong, pushing it in this direction. Well, if you're swimming in the direction of the market, right? If you're swimming in the direction of the market, you're likely going to move further, okay? However, if you try to do the opposite and swim against the current, well, what will happen is you find yourself using so much energy only to move this much. Now, chances are the current in the market will sweep you the opposite direction. So in the same way, now, if you swim in the direction of the current, just a small trade might just swing your way. How many of us have gotten to have entered a position and then the market just, boom, just takes off, and within a couple of, bars or a couple of candles, the market has moved away from our direction, entered, just moved in the direction we're looking to trade. And I don't mean we're scalping, we get into the trade, the market moves. That's what we all like to see. However, what happens most times is people tend to trade against the trend, and for me, it doesn't really make much sense. So let me ask a question. So hypothetically, if somebody sees this market like this, right? If the market is here, so this is the real market, and this is where price is right here. The question I have for everybody here, so I'd like you to just give me just use the chat box and give me a quick answer. What will you be looking to do here? Let me change the color of this to red. So let's say price is currently at this red spot. What are you most likely going to be looking to do here? Quickly, just type in your chat box. What will you be looking to do as a trader from this point? Will you be looking to buy or will you be looking to sell? Let me see your responses. Okay. Okay, so Shay is saying buy. Leslie is saying buy. Now, most people are saying buy, and that's correct. That's the correct answer. So Miriam too is saying buy. Everybody's saying buy. But I can assure you that most of the times, you're not actually looking to buy here. You're looking to sell. Now, most people is looking at this and they look back, whether you're trading from a retail perspective or you're trading from a, okay, so Plantwell saying nothing, which, okay, that's also good. So most people either trading from a smart money, that's the SMC space, or you're looking to trade from a retail perspective. Most people are looking at this and going, oh, this is a double top. This is, let's say, previous order block. There's always there's always something, like there's always a reason to want to look to go in the opposite direction. This is why a lot of people get trapped. And for some reason, yeah, Gozier now is saying sell. For some reason, most people will try to sell from this area. Even people who think the market is bullish will still be looking to, I can just take a small sell and then I'll now look to buy. So what you find most people doing is trading against the trends. The market has shown you already that it is an established bullish market. But still, everybody will be trying to call the tops. Most times, people are always trying to call the tops or call the bottom. Like, oh, the market is overbought. It's overbought. It has made, there's a trend line like so. There is something like this. Let us look for every opportunity to trade this market and the opposite direction. Is the reason why what happens is at a point like this, the market tends to move aggressively to the upside. The reason is lots of people are trapped here looking to do looking to force the shorts or looking to sell the market. And the same thing applies if you flip this and the market is bearish. Most people will be trying to call the bottoms and buy. Okay. Now, what you find just looking at this is, well, if you were looking to buy, right? Let's just assume for all these areas of peaks and trough, right? All these areas of these wavelength areas, peaks and trough. Let's assume we are looking to buy or sell, right? Imagine we are only looking to buy after we've established that the market has, let's say, broken a structure here, grab liquidity and break structure here. Well, for most people, they'll be looking to sell, right? Now, at this particular kind of place like this, imagine if you were looking to sell. Well, in this instance here, if you sold at the very top, this is the only move that the market made. I don't know if you're understanding what I'm saying. If you sold at this very top here, the market moved down, yes, but see how far it moved, just from here to here. In this one, maybe the move is quite significant. In this one too, you're trying to sell from here, look at the move here. This same one, you're trying to sell from here, look at the move here. Same thing here, maybe this is the move. So the chances are, so if this is you trying to sell in a market that is bullish. So if you sell here, this is all you're able to get. If you sell here, this is all you're able to get. And the truth is, chances are you're not going to be able to get a trade at the very, very top, right? So most of the time, before people start to look at this market to sell, the market is already somewhere here. And then when they get into the market, they get wiped out, right? However, if you've understood that the market is bullish, right? And then you're now beginning to look for buying opportunity. Notice how your areas of interest will be somewhere like this, right? Now, remember, you'd also not be able to buy at the very, very bottom, right? But let's say you're looking at this market, you notice that this market you've understood the context of the market, and you're looking for opportunities to trade in the direction of the market. Well, you don't know exactly where the market would begin to so let's use this for instance. So the market begins to fall back down. Now, why other people are like, yes, market is now a bearish market, I'm going to try and sell it. Now, the truth is sometimes the market would now change character or change structure, in which case they'll be like, well, you see, the market has shown a double top and, this happens. But the truth is this is going to happen less likely than this, right? Because the market is already bullish, it's most likely going to want to continue bullish than to change bearish. So yes, at some point it will change and begin to go down, but you would have failed and lost money several times just because you're trying to call the tops or call the bottoms, right? Now, back to what I was trying to say. So in this particular instance, let's say why other people have seen the market begin to, you see big bearish candle and they're trying to sell, you understand the context of the market, and all you're doing is you're waiting for the context of a smaller time frame to align with the overall context of the higher time frame. So let's say this is a weekly time frame and you trade maybe the 1 hour or the 4 hour chart. So you're looking at the weekly time frame, it is bullish. However, the market is beginning to pull back. Now, just because this market is pulling back here does not mean that the structure has changed and this market is now bearish. Now, this doesn't mean that you also need to buy immediately. But what you would like to do is you want to see the markets, now in a weekly time frame, this is still bullish. But if you go down to, let's say, a 4 hour or a 1 hour time frame, this move here is bearish. It will look something like this. Now, what you want to see or what you want to look for is for the smaller time frame to now align with the bigger time frame, where we now begin to have a break of structure here, or however it is you look to trade. And then the structure now begins to align with the overall direction of the market. Okay. So in this particular instance here, you are now looking to trade with the trend, but you're also using the smaller time or using multiple time frames to figure out confirmation as to whether you're going to enter the trade or not. Now, quick one. So far, is everybody following? Is what I'm discussing here, does it make sense to you as a trader? Do you see the reason why? Do you see the logic behind why such approaching the market from this standpoint would make a lot of sense? Just give me your feedback, so I know that we're not all, it's a kind of like a discussion. We're in a classroom session. So let me know if you understand the concept of what I'm explaining here before I go over and show you some examples in the chat. Help me understand if you're following with what I'm saying and if it makes sense from your perspective. Okay, so let me let's clear all this. Let's move on this. Okay, so yes, I'm getting a little yes. Daniel says understood. Gozie, yes. Let's make sure, yes. Okay, so the concept makes sense. It definitely does make sense. Now, there's something I always tend to tell my students is, until what you know becomes what you do, you never make progress. Now, everybody knows what to do. Everybody knows what to do to be a good student or to be the best employee everybody knows what to do on a subconscious level. We all know that it's important that you exercise. We all know that you need to eat healthy. It's good for your health. We all know you need to have a reasonable, a good lifestyle so that you can have a good health, right? We all know this. But just because everybody knows this, you'd expect that, well, if everybody knows what is right and how it's beneficial for them, then it means everybody should be living a good life. But the truth is, the majority of people are not. That means there's a very big disparity between what they know and what they do. So most times as traders, we have an idea of the right things to do, but the issue most times is we do not do the right things. Okay. Now, also as as a point of just to let this one out there, is the concept of multi-time frame analysis. It's actually quite complex in the sense that you can trickle it down and down and down. So, for instance, for somebody who trades a 1 minute time frame or a 3 minute time frame or a 5 minute time frame, what you look for might be different from what somebody who trades a 1 hour, a daily chart, who looks to enter on a 1 hour or a 4 hour chart. So for instance, let's say, now let me show you something on gold. So I'm going to show you a trade I took sometime last year, some trades I took in gold last year, and why I took those trades precisely, right? But I'll also show you the concept of multi-time frame analysis. So if we look at gold here, right? If we look at gold here, this is the chart of gold and this is the daily chart, right? So I'm just going to zoom out and zoom out. You'd see that, okay, let me even go up to the weekly time frame here. Okay, so we'll look at the weekly charts here. You'd see that the context of this market is bullish, right? So this is bullish market, it broke down bearish and then begin to break back up bullish. Now, this is as far back as 1999. Now, we don't need to go back that much, okay? We don't need to, so let me just quickly get this. We don't need to go back that much. However, by looking at this market, you can see that it is bullish on this time frame, this weekly time frame here. Now, I'll show you exactly what was the my idea behind the trade. So understanding that the long-term, the long-term order flow of money in this market is bullish. So my weekly structure looks like this. So this was my weekly structure. Let's just take from here. So this is high to lower high, maybe higher low, to higher high, to higher low, to higher high, to higher low, to higher high, to higher low, to higher high. So at this point, right? So I'm just going, let me make this bolder. I hope you guys can see that. Okay, let's just push it to a side. Now, this is the weekly structure of this market. This is weekly the weekly, you see the market is bullish, it's making higher highs and higher lows. That's how we know a bullish market. Okay. Now, on the other hand, the market also made a, came down here. So what it means is this is supposed to be a protected low. Now, price came down slightly below it. Now, there's a way I also look to approach the market is a bullish market. Now, we like to believe that, a bullish market is always like this. So let me draw this. So we like to think that most people like to believe if the market is making higher high, this is a bullish market. And this is true. But the reality is that in most cases, the market doesn't just make higher highs and higher lows as clean as this. What you find most times is this. So this here is a bullish market as well, right? You can see that it's not always making higher highs. Like it's not, every low is not higher than the previous one at all times. But this market is bullish. This is what I like to call weak to strong hand transfer, right? There's a way the composite man tends to move money. You notice that in many cases, when the price wants to go up, when price wants to go higher, you'll find that price will go down before going up. So this is just liquidity grab or just basically market manipulation to trick you or to trick what do you call them? Retail traders into doing one thing while they're moving price the next way. So just because the market is bullish doesn't mean that it will only make higher highs and higher lows. It's context. Like don't worry, in a different class, I'll teach you how you can I'll teach you more on market structure. But remember, this class is just mostly on multi-time frame analysis. So, well, the point here is that gold has been bullish, right? It's been bullish for my standpoint. Okay, so even though we had this low here, now this is the weekly time frame. Now, obviously, I don't trade the weekly time frame, right? But I understand that my understanding is that this is my understanding here. My understanding here is that, well, if the market is bullish, well, the target is usually the high. So what I mean is, what you notice about the bullish market is where it wants to go is it wants to take out the previous high. So if market makes a higher low, and if the market is bullish and is doing something like this, higher lows, higher high, higher high, sorry, higher low. From here, what is the likelihood? Well, there's a higher probability that price wants to come and take out this high than for price to come down and take out this low. So this high now becomes our target, what I like to call liquidity target. So as the market continues to maintain its bullishness, in a bullish market, the highs becomes liquidity target for me as a trader to go after. Okay. Now, so this all comes into play as regards the trading plan that we tend to look for and how I tend to determine where and how far I'm looking to take a trade. Okay. So with that in mind, okay. So we have our idea that the market is bullish from a weekly point of view and price wants to take out this high. Now, I will tell you for a fact that because of this understanding, I understand that the weekly or what you call it, the weekly structure is bullish. Now, around October, or September, October 2022, this was when price was around here. I was very bullish on gold, and I was also very bullish on gold around October last year again. Now, the reason here, my reasoning for that was simple. The market, yes, it's made a new lower low, but that doesn't change the context of the market. All I needed to see was a price to break this high. The moment it broke this high, I began to look for buying opportunity only. Where do you think? Now, obviously, I did not hold on my trade, but my overall target is I anticipated that price is going to come up and take out this weekly high. Okay, and it took several weeks. But what you would notice from the way I traded is all I looked for was buying opportunities, right? And what that means is I was out of, it kept me away from bad trades while making profit on my good trade. So the thing about this is it didn't mean that all the trades I took because I'm buying were profitable. No, many of my stop losses were hit. But because the market direction is already defined and it's clear and I'm trading in that market direction, well, when I get into trades, the moves are aggressive, right? So when I'm right, so sometimes, let me just move this to the side. So let's say I get into a buy trade like this. If I'm right, most times I have the explosion. However, because of the way I trade, if I'm wrong, I'm just a little wrong. Like, so when I'm right, I'm very right. But when I'm wrong, I'm a little wrong. And I'm wrong more times than I'm right. But because of risk to reward and all of those fancy things that go into your trading plan, I'm on the right side of the trend. When the market moves, the move is explosive, and I'm able to capture those insane RR, those insane risk to reward ratio that one trade can entirely make up for the previous or for the next 15 losses or the next 20 losses. Okay, so it's that kind of approach to trading where you use the time frame as the higher time frame as the base for understanding the structure of the market. And then you begin to use the smaller time frame as your entry, with confirmation as structure begin to change on that smaller time frame. So let's go over and actually look at some fine examples. I'm not going to go back as far as 2022. I'm going to go back as far as 2023 to show you some trades from here and what I was looking for. So this is the weekly time frame. Now remember, I said my entry criteria was mostly is usually based on the 15 minutes. Between the 5 minute and 15-minute time frame. Now, sometimes I get involved on the 30-minute or 1 hour time frame, but my preference is entries based on 15 minutes or the 5-minute time frame. Okay, so now on this weekly time frame, you just see it's just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars from this low to this high. However, if we go down just a bit and let's go down to the daily time frame here, you'll notice that, well, remember on the weekly time frame, the market was very bullish. But notice what the daily time frame looks like. It's making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower low. So the daily time frame is bearish, while the weekly time frame is bullish, right? And then this is where the daily broke bullish and then continue to maintain that bullishness. So now, if I were to ask you, where do you think price is most likely going to want to head? Well, this is the low, so chances are price is going to want to head to this high. Now, it might take many weeks or many months, or it might never even get there. It might decide to change trend and begin to go down. But chances are the probability is higher that price would continue to maintain this bullishness. Now, obviously, remember, I don't get involved on the, I don't use the daily time frame as an entry time frame. I use the daily time frame as even a higher time frame. So I see that, okay, the weekly is bullish. The daily is bearish, so up until this point. But now this is where you begin to apply a combination of things. Now, many of you who are traders, you've learned many things with regard to whether it's support or resistance, whether it's to order block, whether it's to imbalances in the market and how to take advantage of those. But because I understood that this market is already predominantly bullish on the weekly time frame, I had an idea of potential areas where I was looking for buying opportunities. I'll show you some of them, right? Now, here, for those of you who understand order block, you probably get this. We don't just use one thing as a, my trading arsenal does not comprises of just multi-time frame analysis. Okay. So already, because I understood that the market is bullish, I was only interested in buying opportunities. So I had areas like this as potential areas that I am anticipating. Remember, as traders, we anticipate where price would begin to move from. So from this area, when price tapped into this zone, I began to look for buying opportunities on my time frame of entry. Okay. So as price tapped into this zone, I began to look for entry confirmations to buy the market. Now, I made some profit here, definitely, but you notice that price did not go up to our targets, right? Now, price failed. Now, just because price did not go all the way up here, doesn't mean that once I get into trade, my take profit is here, and then because that's not how price move. But because of that understanding, notice how even though price did not go all the way, it gave me enough significant movement to make some profits. Right now, the moment price began to fail and broke below here, well, I stayed away from the market and I was just waiting for price to come back down here. You can see this my weekly SND as I highlighted here. Now, the moment price tapped into here, I was watching for confirmation to buy. Notice how this market is very bearish, right? Now, on this time frame, right? On the let's say on a 1 hour time frame, on a 2 hour time frame, on a 4 hour time frame, this move here would be very bearish. However, I was looking for bullish opportunities. Now, this is not the same as what I explained to you earlier. right? This is now contextual based trading, where I'm using multiple time frames to layer on top of each other to figure out best areas or best times to look for opportunities, and where and what opportunities I should be looking for. Now, on a smaller time frame, sure, looking for selling opportunities would have been great here. However, because of the context of the market, it makes more sense for me to look for buying opportunity because, well, the weekly time frame is bullish, the monthly time frame is bullish, price is tapping into an area that is of strong, what you call strong support, right, or strong demand zone. And the anticipation is, because the higher time frame controls the smaller time frame, the lower time frame was most likely flow towards the direction of the higher time frame, more likely than not. So as price tapped into here, I didn't start buying obviously immediately, but what I wanted to see was okay, so what I wanted to see was, I wanted to see price begin to move, change direction on the smaller time frame. So let's zoom into this a little bit. Okay, so imagine this area, right? Imagine this move here. This is a daily chart. So imagine what it would look like on a 1 hour time frame or a 15-minute chart. It will look like a very bearish market. Okay, and that is true. However, all I needed to see, I wanted to see confirmation on multiple time frames that price is beginning to break back up bullish, and then begin to look for that buying opportunity based on the overall context of the higher time frame. Are you guys following? Does it make sense? Are you following what we're discussing here? And does the concept make sense to you? Just quickly type in your answers there. While we go over to a 4-hour chart. So let's zoom in a little further. So we went from the weekly time frame. Now we're coming down. We went down to the daily time frame. I want to go over to the 4-hour time frame. Okay, so let's see. Yes, okay, great. So I'm saying yes. So everybody seems to be following. So let's zoom back to that area. Now, if we go back down here, so this is the 4-hour chart. This is price tapping into that area. Yeah, here, right? Now, the 4-hour structure here, look at what it looks like. So it went from this high to this low, so making lower lows and lower highs, and lower lows and lower highs, and lower lows and lower highs, then lower low. And then what did it do? It made a higher high. So price, this is where we had the first break of structure on the 4-hour time frame. Okay, so I'm just going to put this like this. So on the 4-hour time frame, this is the movement of price. Okay, so let's see if we can go back to the 1-hour time frame all the way back there. So we zoom back, we move out. Okay, yeah. Now on the 4-hour chart, this is the movement. So this white one is the 4-hour structure of the market. So I'm just going to move it to the side, right? And then I'm going to draw another one, but this one will be the 1 hour. So I'm just going to, this is going to be the 1 hour, higher lows, lower highs. Okay, I'm just doing a quick one. Where's you? So we broke down here, and then we broke up here. So let me make this a different color. Let's make this yellow. So this white one shows the 4-hour structure, right? You can see it made 1, 2, 3, 4 waves before breaking up. However, the 1-hour structure is bearish. It makes multiple waves, almost 10 waves before it broke up. So this is where the 4-hour broke structure here. However, this is where the 1-hour broke structure here. So notice how we're lining up time frames so that we can get that, basically get the time frames to begin to align. So we have the 1 hour breaking bullish here, okay? We have the 4 hours breaking bullish here, okay? Now, I'm going to delete the 4 hour time frame because we already understand that the 4 hour is bearish and then shifted bullish, and then the 1 hour too was bearish and then shifted bullish. I don't know if our chart can go back on the 30 minutes time frame back to that area. Let's see, 30 minutes. Okay, so yeah, we can. Okay, so on the 30 minutes time frame, it looks similar to the 1 hour time frame. Now let's try and do the 15 minutes. Okay, so let's see, is he able to take us back there? No, we can't. It doesn't take us as far back as there. But you get the idea. Let's use the 30 minutes instead. So let's go back to 30 minutes. Okay, so you get the idea. Now, what do you think I'll be looking for? Did I begin to buy? No, I didn't. I waited for, I wanted to see the shifts beginning to happen. I don't want to trade against, even though the bearish markets is the lower time frame trend, I still don't want to trade against that trend. I want the market to begin to shift to the bullish side and then look to ride that trend buying. And so what happened is when the market broke away here, right? The first trades I took on this market was somewhere around, the first trades I took were somewhere around, I think here, somewhere around here. That's why I took the first trade, not down here. Now, after I was obviously observant, we broke bullish on the 15-minute time frame, we broke bullish on the 30 minutes, we broke bullish on the 1 hour, then we broke bullish on the 4 hour. Now, I'm not in a hurry to get into trade because I understand that there are always opportunities. Now, chances that most people like to get, if they want to buy, they want to buy at the very bottom and then expect price to move. Now, it's difficult for you to get this very bottom. So you're just going to be guessing most of the time. But what I like to do is I want to see the market show me that where it wants to go, and then I'll get involved in the market, here. Now, here's the beautiful thing about trading is it doesn't matter where you get involved. I can make more money on a move than on a trade where the market goes from here to here than you will make when you buy from here to here, because of the understanding of risk to reward, right? Because of having a clearly defined trading rules and having clearly defined risk to reward trading, where you risk a specific amount. So whether I take a trade and I end and the trade moves 1,000 pips, or the trade moves 100 pips, or the trade moves 10 pips, I make almost the same amount because I'm trading based on risk to reward. So I'm not really, it makes me not to want to focus on, oh, I have to get in at the very bottom. This is the place to buy. No, as long as the context gets clean, you're most likely going to have your moves sustained, right? So when the market is bullish, notice how, so let me go like this. Notice how if you had bought from any of this place here, right, the price never came back down there. The price never came back down there. Now, you're probably not even going to be able to get involved in a trade like this. Most of the times, the trade will be something like this, maybe like this, maybe like here might be the place you get involved in the trade. But notice how the market moves away from your entry if you're right? So that concept of trading, that idea, that approach to trading is key, right? It's key if you're going to succeed in this game, right? Using multi time frame analysis. Okay, so let me zoom in a little bit and let's analyze what we're potentially looking for. Now, so we see the market the market has now begun to align. The weekly time frame is bullish. The daily is still bearish, mind you, but the 4 hour has now broken bullish. The 1 hour is bullish, 30 minutes is bullish, 15 minutes is bullish. So now I will now begin to look for opportunity to buy. Now, notice how I'm not teaching you a specific entry criteria. You can use whatever system you're comfortable with. Now, some of you trade Fibonacci, some of you trade maybe divergence, maybe some of you trade, as entry, you use trend line or counter trend line break. Notice how the same concepts will apply. Now, if let's say you are a a price action trader, you look to trade in a bullish market, you look for bullish pin bars or bullish engulfing candle. Now, after you've established that the market is bullish, right? And the context is clean from the standpoint of multi-time frame analysis, and you now begin to look for bullish opportunities. Notice how you're not looking for bullish opportunities here. You're waiting for the context to get clean, and then you begin to look for those bullish opportunities, okay? Now, what would you have traded? You now start looking for bullish engulfing or bullish pin bars. Or maybe if you trade Fibonacci, you trade like the 61.8 or the 50 Fibonacci retracement areas. That's entirely up to you. So let's say we do this. You go from low to high. Let's say we're trading the 50 Fibonacci, right? So in this case, the market did not get to your entry. So maybe you don't take a trade here. That's fine. No trade. Again, this is the move here from, let me high line. So this is the move from low, right, to high. And then this is now the new low to high, okay? So you draw your fib like so, there. Okay. Now I don't obviously trade like this, right? But I'm just trying to show you an example, right? Now, this is it got to the 50.0, and then maybe you start to look for confirmation in the form of bullish pin bar or bullish engulfing. Now, obviously, this is a bullish pin bar here, this red one. So maybe your trade looks like this. You enter after that, okay? You keep your stop loss just below this low here. And then maybe you go after 1:3 or 1:4, or you go after this high. But let's just say minimum, personally, the minimum trade I take is at least 1:3. So let's just use that as a yardstick. So 1:3. So somewhere like this, okay? And then the market moves. Notice how this trade runs, right? Now, in the same vein, this is the new low, right? So the new high. And then let's say you wait for the retracement or the pullback. Now, notice how all we're doing here is just look for buy opportunity, look for retracement, look for buy, because the overall higher time frame context has aligned, right? The overall higher time frame context aligned, and then we are confident as to the trade, as to what we look for, right? Now, in this particular instance, did it get to the 50.0? No, it didn't get, so maybe no trade here. Okay, and then you have that over. Now here's what I mentioned something to you guys about the way the markets move. Just because it's a bullish market doesn't mean that it will only make higher highs, higher lows, higher highs, high, just clean higher highs. Notice what it did here. This is higher highs, higher lows, higher highs, higher lows. It just kept making clean higher highs and higher lows until it gets here, and then it broke down. So it broke down, it made a lower low, and then instantly went up and made a higher high. So for instance, for me personally, I would not be looking to sell a market like this, because I understand the context is still bullish, and this could just be a situation of absorption. As a matter of fact, I remember a trade I took here, right? So there was a trade I took here because actually I took the trade because price broke this low, right? So price that's not the low, like this. This is the low here. So price took away that low there. And all I wanted to see personally was I wanted to see price break back above that area and then look for the corrective move to the upside. Okay. Now, yeah. So at this point, you see that the context, you come to the market and you have a clear idea as to what you're looking for and how you're looking to go about it. Now that's key. That's very, very important if you're going to succeed in this business. Having a systematic trading plan, and then you follow judiciously based on your rules. Okay. So I think somebody dropped the question there saying what time frame is. So Daniel says, which time frame do you suggest is the best higher time frame to use white trading? Now it depends on you, but usually in terms of higher time frame, I'll at least expect you to go back to the daily time. Even if you enter the market on a 5-minute chart or a 1-minute chart, it makes sense for you to at least understand where you are in the daily markets, because it would save you a lot of stress and a lot of losses, right? If you understand the market is bullish, the 5 minutes or the 1-minute time frame, or 1 minute your entry time frame, might be very, very bearish. You might see a very clean bearish setup. But then if you don't understand where you are, so imagine this market, right? So let's use this. This market was very, 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 very bearish. If you're trading on the 1 minute or the 5-minute time frame during this period, you'll be very excited because, well, it's just clean bearishness. However, if you don't understand where you are in terms of the higher time frame, when price gets to this area, you will still be trying to force sales. Why not? Why you not be able to, when you should actually be looking at this area as a potential area for the higher time frame to begin to trade back in the overall direction. So which is why, even though you use smaller time frame for entry, you need to understand the context of the higher time frame. I hope that answers your question. Okay, so same thing. Okay, look at this. This was October, somewhere around October. These were some of the trades I took, some of the trades I sent out or something like that. Now notice how now usually I have a specific rules as to how I trade. So the minimum trade I tend to take is either 1:2, 1:3, 1:3, right? But I take profits, I take partial profit at 1:2, and I let most of the other trade run, right? So you can see how Many of the trades here end up being losses. Okay, so this ended up being a loss. This ended up being, I took partial at 1:2. This ended up being a win that, remember, never came down. So I took partial, right? And then after move my stop loss to BE after the context has cleared, and then that ran, right? So you have a trade that ran, right? Same thing here. This was a loss. This was a win, of which price ended up running. How far did it run? Okay, so this took me out. So that took me out at 1:3, right? Because of the context. So you have the idea, even though the market is choppy, because I have an idea as to what I'm looking for, right? And the context is clean based on this impulsive move upward. I was okay looking for buying opportunity, and I was able to capture some very nice trades, right? So some really, really good trades. And notice how I did nothing here. And then I began to look for buying opportunity here. I traded nothing here. I did not try to sell. I didn't try to buy. If the market does not look clean, so let's say gold is not looking very nice, I go and check when maybe USD is looking clean from my perspective. Or there are lots of instruments, as you can see, there are lots of instruments to trade. So I don't have to force a trade on a specific trade because of, oh, I only trade gold, or oh, I only trade US30 or something like that. Because then you'll be trying to force the market when it doesn't make sense from your perspective. And then notice how when this market here, after failing and breaking below here, started to break down lower lows, lower highs, lower lows, and then this is what I'll call kind of like a Wyckoff accumulation schematic here. But you don't even need to understand Wyckoff. You can see that price now began to break high and then began to sustain that high. You can see I had this area highlighted. Now, if I go back, right? Let me do this. If I zoom up, now this is a 30-minute time frame. Notice how this area highlighted does not align with anything. But I'm sure if I go to the daily time frame here, you see how, maybe either the daily or the 4-hour, you see how that lines up, right? How that lines up to, yeah, so this is it. This is that area where price now began to push back up, right? Notice how this area, which was, the market was bearish on the 15-minute time frame, on the 30-minute time frame, just pushing down. And then from here began to move back up. Notice where this is. This is an imbalance, an order block, a leftover order block on the daily time frame, which the 30-minute time frame ran into to then gather momentum to begin to push in the direction of the overall daily and now weekly structure of price. And the same thing here, looking at current price, right? Looking at the current market here. Well, this is, if I were to highlight anything here, I'll highlight anything here. So you have the low to high to lower low to higher low to higher high. So this is most likely, so as a matter of fact, this is the liquidity targets that price is most likely going to want to go after, right? But because this white line here is the weekly, right? This white line here is the weekly liquidity target. So that's where the market wants to go for the week, right? And based on the weekly market structure. Well, chances that this is, this is where price wants to get to, okay? However, based on the context of the daily, there's room for it to get up to this point. Now, if I'm looking at this, what do you think I'm looking for? Well, currently now I'm not trading gold, right? But if I were to do anything on gold, this here is what I will call my protected low. So this low here, this low down here is what I'm going to call my protected low, okay? And then this high here would be what my liquidity target would be, right? Now, so where's here, right? Now, this will be my liquidity target. Let's push this to the side. And this will be my protected low. I think we can delete this one now. Now, so what it means is, if the context begins to align bullish again, right now the market is not doing anything. It's just stalling. So I would like to see price begin to align bullish, at least on the 4-hour time frame first, before I now even drop down to the 15-minute time frame and start to look for context to buy, right? So if the market begins to break up bullish on the 4-hour time frame, I would begin to now look for entry confirmation on my lower time frame to get into the trade, okay? So basically, this is how you apply the concept of multi-time frame, going through, this is something that most of the time I tend to do my overview analysis on over the weekend, so that I understand what markets I'm looking to trade for the week. and which is also important. It's important that I have some live classes. So for instance, every Monday I have my weekly market outlook. For those of you who have a funded account, you can join me for live classes where we look for opportunities in the market on Tuesdays and Wednesdays. But to access those classes, you need to have a funded account. And then, but on Monday, everybody, you can all join me for the weekly market outlook where we look for, trading opportunities for the week based on the context of the markets. Okay. So that's essentially how we apply the concept of multi-time frame analysis. So I think I'm sure most of you will have questions. Just feel free to type in your questions in the chat just down below, and we'll see how many of them we can get to. It'd be nice if you can just give me your feedback as to whether you enjoyed the class today or not. Okay.